Okay, so picture this. It's a Tuesday afternoon, you're sitting at your desk, you're minding your own business, and your phone rings. It's your mechanic. And he goes, "Hey, your car needs a new transmission." And you're like, "Okay, fine. How much?" And he says, $2,400. And here's the moment I want you to think about. Your first reaction isn't, "Okay, no problem." Your first reaction is this pit in your stomach, this immediate visceral panic where your brain starts running through every single account you have, trying to figure out how you're going to cover this. And maybe you've got the money, maybe you technically have enough sitting somewhere, but there's still that moment, that 3, 4, 5 seconds of genuine financial terror where you're not sure. Sound familiar? Because here's what actually happened to me. A few years ago, I had that exact phone call, and I did have an emergency fund. I had the money, but I had it sitting in the wrong place. And because of that, I actually lost, and I'm going to get into the specific numbers here. I lost somewhere in the neighborhood of $1,100 over a single 18-month period just because I didn't understand where my emergency fund was supposed to live. And today, we're going to fix that for you completely. My name is John, and I spend way too much time thinking about where money sits when it's not doing anything. If you're someone who has been dutifully building up your emergency fund, putting money aside every single month, doing the responsible thing, and you've never once stopped to ask, "Wait, am I actually losing money by keeping it here?" Make sure you hit that subscribe button because that's exactly who this channel is for. And give this video a thumbs up if it helps you out. It genuinely helps me get this information in front of more people who need it. All right, let's get into this. Here's the thing that drives me absolutely crazy about the way emergency funds are taught in mainstream personal finance. The advice is always, and I mean always, some version of save 3 to 6 months of expenses, keep it somewhere safe, don't touch it. And look, that advice isn't wrong exactly, but it's so incomplete that it might as well be wrong. Because what nobody tells you, what the financial industry has basically zero incentive to tell you, is where you keep that emergency fund matters almost as much as having one in the first place. Now you might be thinking, "John, it's an emergency fund. It's not supposed to make money, it's just supposed to be there." And that right there is the psychological trap I want to spend the first chunk of this video dismantling. Because that thinking, that passive, it just needs to exist mentality, is costing the average American household somewhere between $800 and $2,000 a year. Let me say that again, between $800 and $2,000 per year. Gone, evaporated. Not because of bad investments, not because of a market crash, just because of where the money is parked. Here's a statistic that genuinely shocked me when I first came across it. According to data from the FDIC and various consumer banking surveys, the average interest rate on a standard savings account at a traditional brick-and-mortar bank, your Chase, your Bank of America, your Wells Fargo, is somewhere around 0.01% to 0.06% as of the time I'm making this video. 0.01%. Let's put that in actual dollar terms, because I think when we say percentages, our brains kind of go numb. If you have $10,000 sitting in a standard savings account at a big bank, which, by the way, is a totally reasonable emergency fund for a lot of people, you're earning about $1, a single dollar in an entire year. $1. Meanwhile, and this is where it gets really interesting, high-yield savings accounts, money market accounts, treasury bills, cash management accounts, these are all giving you anywhere from 4 to 5.5% on that same money, sometimes higher depending on when you're watching this. So that same $10,000 in a high-yield savings account at 4.5%, that's $450 a year, completely passive, zero additional risk. The money is just as accessible, just as safe, and you're making $449 more than you were before. That's not investment strategy, that's just not leaving money on the table. Okay, so before I get into the actual mechanics of where to put your emergency fund, I want to spend a minute on why most people get this wrong. because I think the psychology here is actually really important, and most financial channels skip right past it. There's this concept in behavioral economics called mental accounting. Richard Thaler, who literally won a Nobel Prize for this stuff, identified that we humans don't actually treat all money the same, even when rationally we should. We create these mental buckets, we label them, and once money goes into the emergency fund bucket, it kind of stops being real money to us in a certain sense. It becomes this static, almost sacred thing that we're not supposed to touch or think too hard about. And that mental accounting isn't bad in all ways. It's actually part of why having a separate emergency fund works at all, because psychologically, it doesn't feel like money we can spend on stuff we want. But the downside is that same psychological separation makes us stop optimizing it. We file it away in our brain under handled and never come back to it. Here's an analogy I really like. Imagine you have a really reliable employee. Fantastic, never calls in sick, always shows up, you trust them completely. Now imagine that employee just sits at a desk doing absolutely nothing productive for 8 hours a day. You'd still pay them, they'd still technically be an employee, but you'd be losing a fortune in productivity. That's your emergency fund in a 0.01% savings account. Reliable, trustworthy, completely unproductive. And look, I get why this happens. The emergency word triggers this protective instinct. We want the money to feel safe. And safe in our lizard brain means not doing anything risky. So we conflate earning no return with being safe. And that's just not how it works in practice. There are completely safe places, FDIC insured, liquid, accessible within 1 to 3 business days that pay you dramatically more than what you're probably getting right now. Another psychological thing happening here is the set up and forget problem. Setting up an emergency fund feels like a big financial accomplishment, and it is. You did the hard part. You saved the money. So there's this natural sense of completion that makes it really hard to go back and tinker with something that already feels done. It's the same reason people never update their 401k allocations after they set them up at 22 years old. The action of setting it up gives us the feeling of having handled it, even when optimization is still sitting right there on the table. So part of what I want to do today is reframe the emergency fund not as a one-time task you complete and move on from, but as a position that deserves occasional strategic attention. Not a lot. We're talking maybe one conversation about where it lives, possibly one account switch, and then you can go back to forgetting about it, but now you're making real money in the process.
All right, let's get into the actual options, and I want to be really thorough here because I think a lot of people don't even know that some of these exist, and I want to lay out the complete picture with real numbers. Traditional savings account at a big bank. We've already talked about this, 0.01% to 0.06%. The average interest on $10,000 over 12 months is somewhere between $1 and $6. Completely FDIC insured up to $250,000 per depositor per institution. Highly liquid, your money is available essentially immediately. The only thing this has going for it is convenience and familiarity. That's it. If your emergency fund is here right now, I am not judging you. I genuinely am not. But I am telling you that by the end of this video, you should probably do something about that. High Yield Savings Account, HYSA. This is the option I think the most people have heard of, but the fewest people have actually acted on. Online banks, we're talking institutions like Marcus by Goldman Sachs, Ally, SoFi, Discover Bank, American Express National Bank. These guys don't have the overhead of physical branches. They don't have thousands of employees manning teller windows, so they can afford to pass significantly more of their earnings on to depositors in the form of higher interest rates. As of the time I'm recording this, rates at top-tier high-yield savings accounts are sitting somewhere in the 4% to 5% range. Still FDIC insured, still liquid, you can typically move money to your checking account within 1 to 3 business days, sometimes faster. Let me do the math on a few different emergency fund sizes, because I think this is the part where it really clicks. If you have $5,000 saved, traditional savings gets you 50 cents a year. A high-yield savings account at 4.5% gets you $225. If you have $10,000 saved, traditional savings gets you $1. High-yield savings gets you $450. If you have $15,000 saved, traditional savings gets you $1.50, high-yield savings gets you $675. If you have $20,000 saved, traditional savings gets you $2, high-yield savings gets you $900. $900 versus $2. Same amount of money, same FDIC insurance, same basic accessibility. The only variable is where it lives. $900 is a car payment. It's a couple months of groceries. It's a modest vacation. It's real money that you are currently giving to your bank for the privilege of letting them use your cash for free. Money market accounts. Now, a lot of people confuse money market accounts with money market funds, and I want to be really clear about the distinction here because they're actually pretty different. A money market account is a bank product. It's FDIC insured. It's very similar to a high-yield savings account in terms of safety and liquidity, but it sometimes comes with check writing privileges or a debit card, which can actually be really appealing for an emergency fund because it gives you even faster access to the cash in a pinch. Interest rates on money market accounts from online banks and credit unions are often comparable to high-yield savings accounts. You're looking at 4% to 5% in the current environment. Traditional banks' money market accounts, however, are often terrible, so the same rule applies. Online institutions are almost always going to give you a better rate. Money market funds. Okay, so money market funds are an investment product offered through brokerage firms. Fidelity, Vanguard, Charles Schwab, they all have these. They're not FDIC insured, but they are regulated by the SEC under very strict rules designed to maintain a stable $1 per share value. They invest in extremely short-term, extremely low-risk instruments, treasury bills, commercial paper, repo agreements. The thing about money market funds is that, especially in a higher interest rate environment, they can offer yields that are even a little better than high-yield savings accounts. At the time of recording, some of the best money market funds, particularly those that invest specifically in U.S. Treasuries, are yielding somewhere between 4.5% and 5.5%. Now, here's what most people don't realize about money market funds. If you already have a brokerage account, a Fidelity, a Schwab, a Vanguard account, some of these funds offer same-day or next-day liquidity, meaning depending on when you submit the transaction, you can have cash available pretty quickly. It's not quite as instant as a checking account, but it's not sitting behind a week-long transfer either. The trade-off is that they're not FDIC insured. The risk is extraordinarily low. These things are designed to never break the buck, meaning the price almost never drops below $1. But it's worth knowing that the protection structure is different. Treasury bills. Okay, so this is the option I think is the most underused by everyday savers, and I get genuinely excited when I talk about this. Treasury bills are short-term debt issued directly by the U.S. government. We're talking maturities of 4 weeks, 8 weeks, 13 weeks, 26 weeks, and 52 weeks. They're considered the single safest investment on Earth, backed by the full faith and credit of the U.S. government. In terms of safety, they're arguably safer than FDIC-insured bank accounts. And yields on Treasury bills in a higher rate environment? Exceptional. We're talking 4.5% to 5.5%, sometimes edging higher depending on the maturity and the economic environment. Now here's where people get nervous. John, I don't know anything about buying Treasury bills. That sounds like complicated. That sounds like something sophisticated investors do. And look, I hear you. That was my assumption too. But here's what actually changed my mind. You can buy Treasury bills directly from the U.S. government at treasurydirect.gov with as little as $100. The process is more straightforward than setting up most bank accounts. Or if you have a brokerage account, you can buy them right there alongside your other investments. The main consideration with Treasury bills is the liquidity question. If you're buying a 13-week Treasury bill, that money is committed for 13 weeks. Yes, there is a secondary market where you can sell before maturity, but it adds a layer of complexity. For a lot of people, this means Treasury bills work better as part of an emergency fund strategy rather than the whole thing. The bucket strategy, my personal recommendation. Here's what most people don't realize. You don't have to pick just one of these. And honestly, for most people, the best answer is a combination. I'll share exactly how I think about this. Imagine you divide your emergency fund into two buckets. Bucket 1 is your immediate access bucket. This is 1 to 2 months of expenses. This lives in a high-yield savings account or money market account at an online bank. It's liquid within 1 to 3 days, it's earning a solid yield, and it's there for the transmission that needs replacing on a Tuesday afternoon. Bucket 2 is your extended emergency bucket. This is 3 to 5 months of expenses. This can go into T-bills on a rolling ladder, meaning you're buying a new batch every 4 weeks, so that every 4 weeks a portion of your money is maturing and becoming available if you need it. Or it can sit in a money market fund at your brokerage. This structure means you're never more than 4 weeks away from being fully liquid, but you're maximizing the yield on the majority of your emergency fund. And in practical terms, if you have a genuine multi-month emergency, a job loss, a serious medical event, you're going to have at least 30 days of lead time before you need to access that second bucket anyway. Let me show you what this looks like in actual dollars. Say your monthly expenses are $3,000, so your full emergency fund target is $18,000, 6 months. That's a solid, well-funded emergency fund. Under the old approach, $18,000 in a traditional savings account, you earn $18 a year. $18. Under the bucket strategy, $6,000 in a high-yield savings account at 4.5%, earning $270, and $12,000 in T-bills or money market fund at 5%, earning $600. Total $870. Passive, risk-free by any practical definition, FDIC or government-backed, $870 versus $18 in a year, on money you were keeping anyway.
Now, you might be thinking a few different things at this point, and I want to address the most common ones because I get these questions a lot. But rates change. What if rates drop? Completely valid. Interest rates are not static. If the Fed cuts rates aggressively, the yields on HYSAs and T-bills will come down. This is real. But here's the thing, and this is important. Even if rates dropped back down to 2%, you'd still be earning dramatically more than 0.01%. And in a truly low-rate environment, there are other instruments and strategies to consider. The point isn't that any specific rate is permanent. The point is that wherever rates are, you should be capturing the top of that range, not the bottom. Your big bank's regular savings account will always pay you significantly less than the market rate. That's just how they make money. I don't want to open another account. It's too complicated. I genuinely understand this one. Account fatigue is real. Nobody wants to manage 17 different financial accounts. But here's the counter-argument. Opening a high-yield savings account at Ally or Marcus literally takes about 10 minutes. It's an online form. You connect it to your existing checking account, you transfer your emergency fund over, done. And then you just forget about it. Except now it's making you $400, $500, $800 a year instead of $1. 10 minutes, once, for potentially hundreds of dollars every single year going forward. That's one of the best hourly rates you'll ever earn. Online banks feel less safe. What if something happens? So the FDIC insurance question. I understand the intuition here because there's something that just feels safer about a bank with a physical building. But the legal reality is that your money is equally protected at any FDIC-insured institution, regardless of whether they have branches. The federal government insures your deposits up to $250,000. That's the same whether you're at Chase or at Ally. In the extremely unlikely event that an online bank went under, the FDIC would either transfer your account to another institution or cut you a check. The process is actually well established and relatively smooth. It's happened before, and depositors have been made whole. I've heard that high-yield savings accounts limit your withdrawals. What if I need the money fast?
This is a reference to Regulation D, which used to limit savings account withdrawals to 6 per month. The Fed actually suspended that rule in 2020, and while many banks have kept their own policies along those lines, the practical reality is that for an emergency fund, you're probably not making more than 6 withdrawals a month, because if you are, something has gone very wrong and you need a different financial conversation entirely. And again, the bucket strategy addresses this. Your immediate access bucket covers you for anything that pops up quickly. Okay, but isn't keeping money in cash inherently losing to inflation? Yes, and this is actually a really sophisticated objection, and I'm glad you're thinking about it this way. In a high inflation environment, even 5% yields might not be keeping pace with inflation. In that case, you are technically losing purchasing power on your emergency fund. But here's the critical distinction. This is the price of liquidity and safety. This is an emergency fund. Its job is not to build wealth. Its job is to be there when everything goes sideways. The emergency fund is not your wealth-building vehicle. That's what your 401k and IRA and brokerage account are for. The question isn't, am I beating inflation with my emergency fund? The question is, given that I need to keep this money liquid and safe, am I extracting maximum value from it? And the answer should be yes. So, keep your emergency fund in a high-yield instrument. Keep it separate and mentally distinct from your wealth-building accounts. And then make sure your actual investment accounts are doing the heavy lifting of growing your wealth over time. Okay, I want to do something here that I think really drives this home. I want to run the compounded math on this over a longer time horizon, because I think this is where it gets really interesting. Let's say you're 35 years old. You've got a solid emergency fund of $15,000. You're going to keep that emergency fund until you're 65, 30 years. And let's use a conservative average rate of 3% for a high-yield instrument over that entire period, because we know rates will fluctuate, and I want to give you a realistic, conservative number. In a traditional savings account at 0.05% average, after 30 years, your $15,000 has grown to $15,227. You made $227 over 30 years. That's $7.57 a year on $15,000. I almost feel embarrassed saying that out loud. In a high-yield savings account or similar instrument at an average of 3%, after 30 years, your $15,000 has grown to $36,353. You've made $21,000 without doing anything. That's the power of compounding on money that would have otherwise been sitting completely dormant. Now look, some of that money might get used in genuine emergencies along the way and replenished, so the real-world number is messier than this. But the principle is sound. The money you're keeping for protection doesn't have to be working against you. It can be quietly, steadily growing in the background of your life. And here's another angle on this that I love. Think about the total cost of keeping your emergency fund in the wrong place over a decade. If the rate differential is 4%, meaning you're in a 0.05% account instead of a 4.05% account, and you have $12,000 saved, that's $480 a year you're not making. Over 10 years, with basic compounding, that's somewhere around $5,800 you've just left sitting on the table. $5,800. That's a semester of community college tuition. That's a nice chunk of a down payment. That's a month and a half of expenses. That money could have been yours. It could have come from money you already had, and it didn't because of inertia. All right, I don't want to leave you with all this information and no clear path forward, because the whole point of this channel is that we actually take action on this stuff. So let me give you a concrete, step-by-step process. The first thing I want you to do is figure out where your emergency fund actually is right now. I know that sounds obvious, but you'd be surprised. A lot of people have a vague sense that they have emergency savings, but they couldn't tell you exactly which account it's in or what rate it's earning. Log in to wherever you think it is, find the interest rate, write it down. If it's less than 1%, you're almost certainly leaving significant money on the table, and you should keep going. Next, calculate your actual emergency fund target. Take your monthly essential expenses, rent or mortgage, utilities, groceries, insurance, minimum debt payments, transportation, and multiply by either 3, 4, 5, or 6, depending on your situation. If you're in a stable two-income household with strong job security, 3 to 4 months is probably sufficient. If you're self-employed, in a volatile industry, or a single-income household, lean towards 5 to 6 months. Write down that target number. Then compare where you are to where you want to be. If you're above your target, that's actually interesting because it means you might have excess cash in your emergency fund that could potentially be invested for growth instead. If you're below your target, the priority is building that up before we optimize where it lives. After that, choose your structure. For most people, here's what I'd recommend as a starting point. Open a high-yield savings account at an online bank if you don't already have one. Ally, Marcus, SoFi, American Express National Bank, all of them have consistently competitive rates. Apply online, takes 15 minutes. If you want to implement the bucket strategy, keep 1 to 2 months of expenses in that high-yield savings account and look into money market funds at a brokerage you already use, or T-bills through treasurydirect.gov or your brokerage. Once the new account is set up and verified, initiate the transfer of your existing emergency fund. The only thing to be aware of is that you'll want to leave yourself a few days of buffer, since transfers between banks typically take 1 to 3 business days. So if your emergency fund is your only safety net, maybe transfer it in 2 chunks. Move the majority first, keep a little in your old account until the new one confirms. Then set up a plan to replenish if needed. If you dip into your emergency fund for a genuine emergency, build replenishment into your budget immediately. Treat it like a debt to yourself. Even if it's $50 or $100 a month going back in, the habit of rebuilding matters. And finally, set a calendar reminder to review once a year. Interest rate environments change, new account options emerge. Once a year, maybe in January, maybe on your birthday, whatever works, spend 20 minutes comparing your current rate to the best available rates. If there's a significant gap, be willing to switch. Your loyalty to a bank that's paying you 0.5% when someone else is paying 4.5% is costing you real money. Look, I know that not everyone watching this is in the same financial situation, so I want to spend a few minutes tailoring this a bit because I think that's genuinely useful. If you're just starting to build your emergency fund, the priority right now isn't optimization, it's automation. Open a high-yield savings account immediately and set up an automatic transfer from your checking every paycheck. Even if it's $50, even if it's $100, the rate is almost irrelevant until you've got a meaningful balance. But getting in the habit of saving into a high-yield SHA means that when your balance does grow, it's already in the right place. If you're fully funded and have been for a while, this video is really for you. If you've got a solid 3 to 6 month emergency fund and you haven't thought about it in years, please go check where it is, right now if possible. Look up the interest rate.